Howdy, Jacob here. Today we're looking at Eaton Corporation in the electrical equipment industry. 150 billion market cap, slightly higher enterprise value, a little bit of net debt here. Growth of the last 3 years looks pretty positive, similar to what some other electrical equipment industry companies in the electrical equipment industry that I've seen, but actually declined in revenue from 2014 to it was lower. The revenue was lower from 2014 all the way to 2022. Only in the most recent year did they go above their 2014 revenue levels. And their gross margin is higher, though. Operating margin is higher. So I do like to see that for companies that are very slow growth or in the more mature stages of their life. And at $150 billion in the electrical equipment industry, you're likely a bit more mature. I do like to see companies being more efficient with the money that's being made. So if a company over a 10-year period increases revenue 40%, I do like to see a 50 or 60 plus percent increase on the margin side, net income, free cash flow side, because that's saying that with each dollar that is coming in, they're making even more money on that dollar. They're being more efficient, which is absolutely positive and something that mature companies, if you have a really good return on invested capital, can do very well. And return on invested capital here is not astronomical, but high single digit, low double digit, not bad. Probably right on par with their weighted average cost of capital. Dividend is a hefty amount, not so much that they're going to have to cancel it anytime soon, but majority of their cash flow is appearing, at least on the earnings side, to be going to or towards this dividend. R&D spend is maybe, 1% is 232, so maybe 3%, 4% of their revenue is being expensed as research and development. That's taking a little bit of money away from today to make more in the future. 3 to 4% is really not much. There's not a whole lot of opportunities for them to reinvest at this research and development to try to find different ways to make more money. But even still, 3 to 4%, glad to see that they're doing something, trying to find other ways to, make more money, be more efficient with it. So I'm not against that. $2 billion in short-term investments, $500 million cash on hand, with about $9 billion in short-term and long-term debt. $9 billion in relation to their free cash flow is about 3 years, so we're not terribly concerned with the debt that they currently have. But they do use a majority of their money to pay this dividend as expected, and then they also use a little bit for acquisitions, a little bit for share repurchases. So I think that's enough to get me to make some assumptions here for Eaton Corporation on the revenue growth side, with some acquisitions, assuming a little bit of capital allocation goes to that. Probably 4% seems reasonable to me. It's a pretty mature business, not a whole lot of debt. I'm pretty comfortable with that 16, right around market average PE, price to free cash flow. Margins have gone up on the net income side, or not so much consistently looking like that on the free cash flow side, but I think I still feel comfortable with something like 11 and 9%, with a share change, 11 and 10%. Share change of 1% for them is about $1.5 billion. And I don't think they consistently do that. They do that maybe every other year or something. So let's say 0.5% a year. The dividend, they've been increasing it pretty consistently. Let's just increase it with their revenue growth so the payout stays relatively the same. And it still looks extremely overpriced at this price point. So 40 PE companies, to me, need a lot of room to grow. And to me, from what I'm seeing in the last 10 years on their income, cash flow, balance sheet, everything that I'm seeing from a financial statement standpoint tells me it's a stable company. And so for it to have the highest margins it's ever had and still have a 40 price earnings ratio tells me that it's overpriced, and it would take a lot to fit into this valuation in my eyes. And so this doesn't mean I'm shorting it. It just means I'm not buying it. I just don't understand the current price. Here I'm saying it needs to fall 80% to get to the price I'm looking for. So I don't think the growth is definitely there from what I'm seeing. The last 3 years have been great, but I don't think you can use the best times of a company and not take into consideration a cyclical business and the worst times for the company as well. Hope you enjoyed the video. Have a great day.